Sam Stovall, Chief Investment Strategist at CFRA. Sam, always good to see you. Thanks so much for joining the show.
Happy to be here, Caroline.
So I know you have a new 2025 S&P price target. Not sure if you heard our last guest, but he's definitely more cautious heading into 2025. But before we get to that new price target, I do want to talk about now to year end, because I know you use history as a guide. We've known each other long enough. I know your old adages and such. And I know seasonality is on our side post-election. Santa Claus rally, we're heading into a seasonally strong period. That being said, the S&P 500, even with today's little bit of a pullback, is still up almost 26% year to date. So how high is that bar for Santa Claus to clear?
Well, Caroline, I think it's only about 2% to go. My year-end target is 61.45. But like your prior guest, I think that 2025 will be a bit more challenging. And I have a 65.85 target for the end of next year. But let's focus on December. December, whether you looked at all December since World War II or just election year Decembers, it has been the best month of the year, posting the highest average return, the highest frequency of gains, and the lowest volatility. And taking that one step further, in an election year, December has seen a 40% lower volatility than the average for all other months of the year.
Okay, so that 65.85 for 2025 is 7% higher than where you think we'll end at the end of this year, which would be 2% higher. So it's essentially 9% higher than where we are right now.
Yes, exactly. So a little 2% more to go this year because of the good momentum, seasonality, likelihood that the Fed will be cutting interest rates in December, and really the things that investors have to worry about from a new Trump administration won't be enacted until January 20th.
So there was a time that 7% returns actually would be still pretty impressive, not necessarily the past few years. So I think, do we look at that as the bull market continuing into next year if you're expecting 7% gains? And I guess why the gains, but also why the slowdown in the pace of those gains?
Well, you're absolutely right that I like to call myself a bull, but with a lowercase b. My feeling is that the third year of bull markets historically have been very challenging for investors. Of the 11 bull markets that celebrated their second birthday, the following year, they were up only 2.2% on average. 3 of those bulls turned into bear markets. 2 more posted negative returns, but not enough to make them new bear markets. 3 more posted gains of 6.5% or less. So really, fewer than 1/3 of the second year bulls were roaring bulls by the end of the third year. Also, the first year of a president's term in office, 90% of the time, we have seen declines of 5% or more, with the average being 17.5%. So basically, the advice would be to fasten your safety belt. It probably will be a good year, but not a great year in terms of returns, but a pretty volatile one.
All right, so fastening our safety belts for volatility. So that's been the theme so far of this show. We heard that from the last guest. He's pretty negative on some of the big winners from this year heading into next year, including AI, big tech. Seem to like cyclicals better. And when you think about sector underperformers, sector outperformers for 2025, what are you thinking?
Well, I'm thinking right now that the tariff talk is more bluster than reality, and I think that's how Wall Street is playing it. And so we are sticking with our winners. Let your winners ride, being the old adage. So we have overweight recommendations on communication services, financials, industrials, technology, and we think that the defensive areas, in particular consumer staples, healthcare, materials, energy, are likely to be underperformers, really because the focus will be where the growth is. And those overweight sectors are the ones expected to show the greatest year-on-year growth, not only in 25, but in 26 as well.
So underweight some of the more defensive sectors. Does that mean you expect the economy to hold in there next year, to remain resilient?
Yes, I do. 2.8% is our GDP growth estimate for this year, 2024, 2.4% for 2025, and 2.2 for 2026. So you can see that we are at least engaging in a bit of a softening. Maybe you call it a soft landing or you call it a close to touchdown, but still growth is expected. We expect to see retail sales to remain fairly strong. What's the old adage? The consumers stop spending only when the banks stop lending. And so our belief is that what could be holding us back are valuations, whether you look to PE, price to sales, price to book, et cetera. We are trading at fairly lofty levels. So a correction, at least in time, would be helpful.
So, Sam, what would make you more bullish heading into next year or even at the start of next year? And what could potentially jeopardize that 7% rally that you have penciled in?
Well, what would make me more bullish is if we started to see significant upward revisions to earnings estimates, because right now the S&P 500 is trading at a 22% premium to its 10-year average PE, but at a close to 40% premium to its 20-year PE. So I would prefer to see some of these metrics strengthen and thereby make the overvaluation look less dramatic. I think what could cause me to be much more concerned is if we did indeed go through with a lifting of tariffs against our major trading partners, because the worry could be if we have a slowdown in economic growth here, that could end up exacerbating the global slowdown and have something reminiscent of the Smoot-Hawley tariff of 1930.
But Sam, we've had tariffs before. We've had a trade war with China before COVID hit. I feel like that's what we were talking about at the end of 2019 and the beginning of 2020. How concerned are you this time around? How would it be different?
Well, that's why I'm thinking it's probably more of a bargaining tool than it is an outright actuality. And that's why the market is likely to see a bit of improvement between now and year end and still end up with a good 2025. But only 1 in 5 times have we actually had a three-peat or 3 consecutive years after the initial down year in which the market was up by double digits. So just going on percentages, I think investors would be wise to realize that double-digit gains are not the norm in the third year, and you'd be better off focusing on high-quality growth stocks rather than really going for the low-quality issues.
So, Sam, just to kind of summarize, this isn't necessarily about taking money off the table and out of equities. This is just about kind of shifting where that money goes.
Absolutely. Or at least shifting the mindset and adjusting the expectations, maybe reducing the trajectory of expected growth. So instead of, hitting a third grand slam home run, I think investors should be hoping for a double, or maybe even just be happy by getting on base. Sorry about the baseball analogy, but the thought being that, no, we're not headed for a bear market, in my opinion, but possibly not a return that will replicate what we had this year or last year.
All right. I don't mind the sports analogy when I can actually understand them, and I did understand that one. So, Sam Stovall, CFRA Research, always appreciate your analogies and your insights. Thanks so much.